So thank you very much for being with us this afternoon. Uh, uh, like I said, I'll take about 20 odd minutes to give you an update in this call about our portfolio, our view, and then we'll open up for the questions. So we can make it more interactive and meaningful for you. Let's get into it. So we'll capture some of this agenda item. Let's first get into before I start into the port. I mean, some of you might be new, some of you might be invested into a particular strategy. So this is our landscape of all the strategies we have. Carnelian Compounder Fund is what we started with the first in 2019. That's our multi-cap strategy, both in PMS and AIF format. Then Shift strategy, as you most of you would know, that our manufacturing. And technology, what we started in October 2020. That is again there both in PMS and AIF. AIF for these both portfolios have been closed. Only PMS is open. And then we launched Carnelian Bharat Amritkaal Fund, again a multi-cap, flexi-cap strategy last year, which is an open-ended category 3 AIF. So these are our strategy and bespoke Carnelian bespoke strategy, the customized portfolio which we do for our clients, large family offices and clients, which are customized portfolio. And contra strategy is what we started as a contra plays in 2022 to capture contrarian opportunities in the marketplace. So these are some of our kind of strategies. And if you look at how they performed on the performance in last 1 month and last 3 months, and since beginning, you would see last 1 month we have kind of done very well across our portfolios. While the markets have been up about 3.5%, all our strategies are 7 to 9%, 10% up. Also on a 3 month basis, our performance across the board, Carnelian Compounder Fund, both strategies are delivered about 21, 23% return. Shift is up about 16%. Bespoke is up about 21%. Contra is up about 13%. Bharat Amritkal is up about 18%. And India Amritkal is, of course, replica of Bharat Amritkal, but this is an offshore strategy. That's up 23%, but that looks largely because of also dollar returns, because I think we had a little bit of an advantage because of the rupee appreciation. Otherwise, it's a replica of the portfolio. So I think if you see across the board, our endeavor has always been to deliver superior risk-adjusted return. Of course, when markets go down, we will also go down, but how do we fare once the market stabilize? That is the real test of any portfolio. And hence, while there is a long-term alpha which we have tried to create across our portfolios, some of them, of course, have been, Amritkal has been around only for a year, but our longest portfolio is compounded, which has been around six years. Shift strategy is around for a little less than 5 years, so almost 5 years. CAGR is about 38%. So we have all kind of vintage of the strategy, and across the board we have tried to deliver returns in terms of resilience of the portfolio. During the downturn. So if all of you know that last year September 26, when the market peaked out, and then we saw a market sort of correcting significantly, especially in the mid and small cap space. And we just also tried to look at some data that how did our portfolio sort of do from that point of 26 peak to now, last peak to sort of now. And if you see across in that period also, our portfolios have delivered good alpha across the board except contra, but that's again a different nature of the strategy. But and again, that's also temporary, I do believe. But across the portfolio, we have seen significant, good outperformance, and that shows that our portfolio resilience is fairly good. Even in the downturn. And also, if you were to look at, on the 4th March when Trump announced tariffs, we saw markets kind of going down. We of course did a call with all of you, after that as well, just to give our view on the market. But how did market recover from the recent low of the March to now? Also, our strategy kind of, or each strategy took the dip, but again, all of them have come back and delivered good returns. So these are just a little bit of cut to show you that how our portfolio tends to kind of, when markets are, bad, No portfolio can survive that kind of onslaught, good, bad, ugly. But real quality of the test of the quality of the portfolio is how do you come back? When markets come back, do you come back better than markets in that comeback period is actually the real quality of your portfolio, because eventually good quality will come back with a lot more sort of, pace. And that's what at least, we feel happy about that. If not, same pace or better pace is something what we have seen in our portfolio. So this is again our conviction that over a long period of time, we should try to outperform market on a sustainable basis between 3 to 5%. And that's our internal sort of target. Anything above that is great, but at least that should be the base we should be, and keeping the portfolio quality in mind, keeping the sort of volatility of the portfolio in mind. This is again graph you might be familiar with. Many times I've shown that one of the things which we aspire to have our portfolio should be faster, stronger, and cheaper. Faster in terms of growth in revenue and earnings, vis-a-vis the benchmark. And if you see, both revenue and earnings growth, vis-a-vis benchmark is solid, stronger on ROE and debt to equity ratio. So ROE, if you see, our portfolio is between 18 to 19%, whereas benchmark is in around 15%. Debt to equity ratio, again, we have hardly kind of leverage in our portfolio. We generally are, we prefer less leverage companies. So if you see, while index is zero point 0.6, but we are like zero point 0.0 to zero point 0.1 kind of leverage in our portfolio. And cheaper in terms of peg ratios, right? In terms of we should be cheaper because what we're paying price for growth. So it should be cheaper than the benchmark. And if you see that also we are in and around 1.1. And that's our kind of comfort zone. We are looking for high growth companies, and we don't want to sort of overpay for that. And that's the sweet spot, we look to do when we call ourselves quality growth at a reasonable price. That's our key philosophy, and that reflects into the valuations of our portfolio, which says. And finally, I think portfolio beta is an outcome that how does your, while we have delivered outperformance of between 8% to 16, 17%, beta of the portfolio remains, less than one. And that's the real, again, sort of test the quality of the portfolio, because, that shows that how robust your portfolios are, vis-a-vis the market volatility of the portfolio. So while we don't target any beta, but we think that our stock selection process creates an outcome in form of a portfolio which is far more resilient, which reflects some of these numbers as you are seeing on your screen. That's what it's like. Yeah. So I know Amritkal, we just thought we'll share some of the portfolio, or a little bit facts about our, Bharat Amritkal Fund is what, we launched about a year ago, and many of you have heard our pitch on that. Many of you have sort of seen, and if you've not, I would strongly encourage. It's a 20 minutes presentation. You would love listening to that presentation. The kind of data which and one of the reason, when we launched Bharat Amritkal Fund, we also said that we want to tell our partners, investors, that how to look at India from an opportunity space, from next 20, 25 years perspective. And once you have that perspective, your ability to remain invested with the right perspective, is always there. So whether you invest or not, but I would strongly, advise you to kind of go through that presentation. It's a 20 minutes video. It's on our website. Strong. So this basically invest across these five broad buckets: manufacturing, banking, financial services, infrastructure, and consumption. Five mega themes of the economy. And this is a flexi cap portfolio. We adjust according to whatever we think within these five buckets, but it's a very, very high quality portfolio. Like I said, performance has been good, but more importantly, we see a very solid growth in times to come. These are some of the top names in the portfolio. Of course, it's about 30 odd 30 30 two odd stocks portfolio. So with little concentrated bets, as you could see in the portfolio. Kotak Mahindra Bank was our recent, pick when it was about 1850 or 1900 levels, when we took sizable position in our portfolio, and we think it's a good risk reward trade right now. Same way, Aditya Birla Capital, it's been our long held stock. We bought it at started buying at 100 rupees when nobody was sort of looking at the stock. Today, at recently, some of you might have noticed at 250 rupees, 240 odd rupees, a lot of large, high quality institutional investors came and they bought almost about, I think, 5 or 6% of the company. So, and we continue to remain very, very solidly optimistic about this business. As I think Vishakha is building this business in a very solid way. She's a fine leader, and we love companies where there's a transformation happening led by a particular leader. And that's where I think the stock has got re-rated from one time book to 2.2 time book, and we think it's still long way to go. Just like our next holding, which is ICICI Bank, as many of you know that we've been holding for a very long time. We bought it at around 285, and it got re-rated from one time book to three time book, from cheapest stock to most expensive stock. So I think similar kind of journey we are seeing happening in Aditya Birla Capital. So without going too much each name by, but I'm just saying this gives you the quality of the portfolio which we are kind of building. This is just a snapshot of Bharat Amritkaal Fund. Uh, this is again compounder fund, which has been our first fund, which I like. I started with that. In AIF, of course, we cannot accept money anymore because it was a close-ended AIF. But PMS continues to remain there. So in some sense, I jokingly call that I mean Bharat Amritkal Fund in AIF format is the current the Bharat Amritkal Fund, and our multi-cap in PMS is a compounder fund. So here again, we have a very large overweight in banking, pharma, in an APIs business. Even we have in banking, non-credit also very large exposure. We think it's a some high good quality businesses we own there. Capital goods cycle, we've been very, very positive, and you can see reasonably good outweight there. IT, we are kind of equal weight with tech kind likes of Tech Mahindra being one of the large player, where we have a significant bet on Mohit turning around the company's margin from 9% to 15-16%. And as that happens, the stock will get re-rated. In fact, otherwise weak IT cycle, the stock has already done well. We started buying it around 11-1200 rupees, and it's already right now done well. But we think there's still long way to go in this stock. So like this, I think we have a very, very high quality portfolio. And if you see portfolio attributes of the our revenue CAGR, earning CAGR, some of this was there on the earning on those graphs as well. So this is just reflects what kind of sort of portfolio quality we have. Shift strategy, which I'm sure many of your investors, this is one of the most popular strategy we have. We started with, in October 2020, with the theme that manufacturing is going to be decadal opportunity over the next 10-15 years. While there were many skeptics that point in time, but now there are a lot more believers, and this strategy has delivered fabulously. Uh, Pharma API continues to remain large bet. Engineering capital goods continues to remain large bet. IT, and we are around 15%, which is kind of equal weight. Earlier, we were 25%, which we reduced and brought it down to 15%. Still, we are quite convinced in some of the names which we have in that. Auto Anks, about 15%. So it's a reasonably good weight spread. When manufacturing does not mean that it is kind of concentrated in a particular sector. As you could see, it's quite widespread. While it is, technically qualified as manufacturing, and each of these sectors have a very different levers of growth. So none of them are correlated. So it's not that something going wrong, manufacturing entire portfolio will collapse. This is a very question, very commonly we get that. And this kind of sector allocation should give you idea that in this, actually, other than banking and maybe real estate and infrastructure, you have practically all sectors open. And that's a basically width and diversification of the sector in this. But here we look at with the bent of mind of what is position between import substitution and export oriented, and where you can see an accelerated earning growth. As you could see on the rightmost column, that our earning growth in this period is expected to be around 24-25%. So that's the kind of growth you want to really capture in this portfolio. And that's the reason it has been also one of the most performing strategy also for us over last a little less than 5 years. Uh, so this is some of the stock wise contribution. While I am, I picked up some of them, but uh, Yatharth Hospital, play on the in compounder. Again, most people didn't buy. And this stock had, by the way, last quarter a negative news flow in terms of some house citing negative news on the report on that, and stock went down. But we went back, checked, and did our quality, our work on that, and we didn't panic and stayed back. And stock has today come back. It gave us a little bit of a underperformance that time, but I think we kind of recouped back because we believe that business is fundamentally solid, run by very good people. Every business can have up and down, but I think so. Hence, we kind of bought it. GSK Pharma, again, a very good play. We bought about 6 months ago. Stock is up significantly from the price we bought, but we think it's again a long turnaround play, high growth play. Companies got into from a slow growth phase to high growth phase. And I think we think that that will continue to remain for at least few more years. And we would love to capture that in our portfolio. RBL is again, generally we don't buy. You must have heard me saying small banks we are not a big fan of. We don't buy unless there's a specific opportunity. And here we got into RBL Bank around 150, 160, where we could see a stock available at point 0.5, point 0.6, and a good turnaround in the number visible to us in next couple of quarters. And when we bought at 150, 160, we could see a clear path towards 300, in a year and a half time. And that's the reason we took a sizable bet on the portfolio in the portfolio. While it is not our natural liking in the banking sector, we typically like only large banks in a financial services sector. But in investing, one thing I have learned, the only dharma is risk reward. If you understand risk reward of any company, which you think can, the downside is limited, upside is more, then and you factor all the potential things in that, and then take a view. And that is what we ended up doing in this. And stock is up, of course, from the price we bought, but we think still legs to run in this. Right. Another company I maybe like talk about is Paytm. In 2021, we had written a very big notes about the new age company, Fad, FOMO, Fade. Some of you might go away, and we were very, very critical of the new age companies, their valuations, and we never participated in any of them. But does not mean that we never monitored them. We were understanding, monitoring, doing, and about 6 months ago when we studied Paytm, we thought risk reward was falling in place. Platform is good. The founder is trying to focus on cash flow rather than burn, and that really excites us. So we kind of bought it. I think around 600 odd levels. And I think we think there's a good legs to this, and it's a decent play right now. So when the risk reward falls into your play, you don't remain stuck to your one view you took particular one point in time. You kind of change your view and then move on that. And that's what we did. And that kind of also gives you some sense into our flexibility in our approach. We are very flexible, provided you understand what you're doing. Laura's Laboratories, again, contrary to everybody's view, we bought stock around 300 levels, and it has been our large position, as some of you know, for a very, very long time. And it continues to remain so. And we think that's a fabulous company placed in CDMO space. And we intend to hold it for a very long time. So like this, each of the business we have a very, very good sort of sense. Manufacturing mein KPR mill we've been owning for long. I remember when we did our launch call, we bought it around 5,000 crore market cap. I think it's right now about 25 or 1,000 crore market cap, 5x in almost 5 years. And like this, and we continue to remain positive on this. BHL power sector, there's a huge shortage in the country of the power, and it's expected to be so with the data consumption going up. So we have chosen renewable. We don't understand risk reward given the valuations of most companies, whereas we understand there's a huge operating leverage, hence we bought it. Yeah. Sanatan Textiles, again, commodity textile companies, which usually you will not see us buying, but it's a fabulously managed company with a lot of capacity going live. And that going live itself will double their profits. And we think that itself will double our money without re-rating possibilities. And that re-rating is also possible. So we see a good risk reward happening out here. Uh, you know, uh, yeah, so I think I have kind of touched upon most of the names which you should know about. But we are like, and you will find a very flexible approach in our investing. Our team constantly keeps on looking for ideas. We are not married to a particular theme, not married to a particular opportunity, a particular company. All we are saying, we are risk reward guys. We must understand risk reward of what we are doing. And once we understand risk reward, we do take risk. Some of the draggers in our portfolio, of course, everybody has that. And like, J&K Bank, we didn't lose money, but of course, we didn't make money. I think given what's happening in J&K, some of the, I think, hypothesis of our growth got pushed. And also the previous CEO changed, went back to SBI. So we thought while bank still is fine, there's no major risk, but we thought the money could be used elsewhere. And hence we have done some shuffle there. Dabur also, again, good company can have, but we felt that the risk reward of money invested somewhere else is better. Hence, we kind of invested there. VIP, we still remain invested, but it has kind of put a little bit of negative on our this thing. We are watching the company very carefully. While it's not a very large position for us, but yeah, it's a small position, but it has kind of put a little bit of underperformance on our this thing. LTTS, while it's a good company, it had some poor performance, but we remain invested in the company for because it's a very high quality company. Quick Hill, again, one of those bets which we got into at 2,000 crore market cap, not and we think that it's a very, very high quality company from a cyber security space perspective, only Indian company in listed space, and has a huge, Vishal is driving major transformation out here, who's come from Infosys, who's the CEO of here, is driving major transformation. Now, in between, of course, market got significantly excited and stock went to from almost 700 rupees, and in the recent crash came down back to I think 280 or something, and again recovered back. So I mean, this volatility has nothing to do with the business, but that volatility obviously can impacts our sort of performance. So some of these stocks have had some impact on our portfolio, but it's not something. I mean, all the performance you saw was after taking knock off some of these detractors. You will find some of these new entries. Star Health is again a fabulous business. I think there's a good turnaround happening. It listed at a very high price. When it got listed, we didn't understand the risk reward. We stayed put, and while everybody chased that point in time, but we kind of didn't invest, and we saw it's a good business, but we saw stock coming from almost 700 to 350 bucks. So, and then now I think we see a good turnaround happening in the company after we bought. I think one of the promoter also added in the market. Edelweiss, we recently bought again. We see a lot of deep value in the stock. They have a couple of what do you call value unlocking happening over next 6 to 12 months time, and as that one through IPO of EAAA and other one value unlocking happening, I think we see a very good risk reward of the stock. And our expectation is probably stock can double in next 1.5 years time, and that's the reason we've taken a decent position in this. Like I said, Dabur, we exited recently. Deepak Nitrite, we had a very small position, so we wanted to consolidate the holding. Nothing wrong with the company. We are bullish on the chemical cycle. Company is still good, but we had a very small position, so we thought, why not to consolidate and put some in something else? That's how we got exited. We spoke about Shift. In Sanatan, we got in. Timken, we bought recently. We had bought actually in 2020 and then sold in 3 years time, in 2 years time, because stock did very well. And after that, we saw, because we saw market priced everything in for next 2 3 years, and then recently stock came down, and in this period of they did capex as well. So now the capex is going live, and valuations came down. So we think from here it's a good risk reward trade. Hence we bought it. Uh, Syngene, we exited after holding for 5 years without making much money. So it's been one of the big detractors for us. Again, potential of the company is not changing, but I think they have just not been able to deliver. And we actually wanted to buy Biocon. And as we bought Biocon, we swap some of our position, which is less high holding company of this. And there's a lot more happening. So we kind of swapped our position from Syngene to Biocon. I think it's not mentioned that we have added Biocon in this, but yeah, we did that. Uh, Bharat Amritkaal Fund, we bought L&T, Sun Pharma, Star Health, Edelweiss, and swap some of these to same names you see. Again, in terms of earning quality, earning growth, our portfolio has delivered last quarter as well as this quarter also broadly better than the indices. And again, last year we only obviously saw earnings growth slowing down, and I'll talk about a little bit why it slowed down in a while. But if you see, our general approach is that earnings growth should come our portfolio, and it's not that we've not had disappointment. We also have had disappointment. Our expectation would have been higher, but in general, as long as we have a lesser disappointment than market, I think we are all right. And that's our constant endeavor to do that. So this is a quick update, on our portfolio performance names, and if you have a specific question, would have love to take that later. But let's kind of come to the macro. What do we think? What's happening in the market? What's happening, in economy, and or what's our view? So if you see last year, generally speaking, I am talking about more last financial year. When we began the last financial year, Shaktikanta Das was governor and unsecured loan was growing very fast. So he somehow himself found and rupee was kind of depreciating. So to support rupee and control the unsecured credit growth, he created deficit in the system, liquidity deficit. And that also got coincided with the general election last year. And in general election, what happens is the government bureaucracy, does not focus on releasing payments in the system. So payment also got released less. Hence, there was a huge liquidity squeeze in the first half of last financial year, which impacted the corporate earnings with a lag of 1 or 2 quarters. And that's the reason you saw December 24 earning and, was kind of very, very, poor. You saw significant slowdown happening. Started in September, December, it kind of hit the trough. And new governor came and he started kind of pushing the liquidity in the system. And so we are seeing that two policy pivots happened. One, I think government started spending money post formation of new government, and RBI started cutting rates aggressively, push liquidity in the system. So we have seen 100 basis point kind of cut in the system. We have seen liquidity deficit of 3.5 lakhs getting positive to 2.5 lakhs. In fact, even more now as we speak. So I think this governor is very, very clear that he wants to support growth, he wants to promote growth, he wants to boost the growth. And especially when the global environment is uncertain, it's a very sensible policy where our inflation is very much under control, and there's no point in stifling the economy of liquidity and kind of, so I think it's a very sensible approach. And we think that this will have a huge impact with the earnings lag. And this news, of course, when global gloom and doom is happening, market don't pay too much attention to that. And that's the reason we saw Feb, March, April remain very, very uncertain environment. Of course, we have seen the recovery of that happening. But I think, reasonably a lot of positive news happening. And if you see in this chart what I was talking about, this is the ratio of, companies missing estimate versus companies beating estimate. In December 24, more companies missed the estimate than beating the estimate. But in March 25, as the governor started, he came in, last year and started pushing the liquidity in the system, you kind of see that company beating estimate number going up, right? And we think that this is only going to go up throughout this financial year. And this is a very important sort of data point to see, because ideally speaking, in an environment where the companies beat estimates, market and ends up doing well. And and last year, see, as this number was going down, market also tends to kind of go down, or see disappointment. And every time there was disappointment, stock price of a company goes 20, 30, 40% down, depending on which company you are in. So this is a very, very important data point. You must sort of look at it. And other is, of course, the the cost of capital between US and 10-year yield. All of you know that is very, very low, all-time low. And that continues to remain, very, very solid. India's interest rate continues to remain go down. And, it means India is becoming significantly competitive at a global level in the cost of capital terms, which historically was a very, very big, pain for India. It is very relevant for both A, our competitiveness perspective, and B, from a valuation perspective, which I will come to, a little bit later, that how this is a very, very big impact. We'll talk when we talk about valuations on this point again. Typically, whenever, again, you can see from the data that whenever the rate cut cycle happens, you will see growth picking up with a lag. And I mean, historically, we have seen multiple points in time that, you start seeing the benefit of rate cut trickling down, and acceleration in growth depends on between 3 to 6 months. So we have a huge conviction that whatever has been done, you will see a big, big pickup in that post, in next, you will start seeing that impact of that in next 3 to 6 months time. And that's the reason we are again and again saying that, earnings will be very robust this year as we move forward. And you will see still a lot of participants in the markets don't believe that, earnings will sort of accelerate. and hence most analysts still have kept their estimates. We haven't seen significant upgrades happening in the estimates yet, but that will happen, in my opinion, as we get into the year, maybe from Q2 onwards. Private capex is picking up. There's one big narrative keeps on going around that private capex is not doing well. And again, I'm saying we've said this multiple times, and I'm repeating again that we do not know any company which is not expanding. When you look at the order book of the companies, which are aligned to the capex cycle, they are full. The order book cycles, delivery periods have gone up from 6 months to 18 months and beyond. So, people are now who are expanding are actually beginning to plan that plant. It will take time for plants to come back, because the order books are kind of getting bigger and bigger. And so it's a myth. And hence, again and again, I repeat that, capex is picking up very, very well in the economy. The reason why a lot of people believe that capex is not picking because they link historically they have used credit growth, corporate credit growth as a proxy to capex. But that's not the case incremental anymore. Uh, now capex is happening through internal accruals, equity fund raise. So capex is happening. It might not be happening through the same source as it was happening in the past. Hence, that proxy test of many people may be failing. But capex is kind of very, very robust. Liquidity cycle, again, we all know that DII flows have been fairly robust as far as the liquidity is concerned, and we don't see anything changing because still India's household exposure to equities is less than 5%, and this is only going to go up in times to come. We did this an estimate that if in next 10 years this 5% goes to 15%, 10%, India will receive another $2 trillion of flows from domestic investors. So it's a huge trend for more much like what happened in US in 401k movement, and I don't think it's changing anytime in a hurry or at least for next 5, 7, 10 years, I don't see it changing. FI flows, which has been erratic, and again, we have said this many times in the past that FII, especially India, is part of emerging market basket. Whenever Fed raises interest rates, the global investors pull money out of emerging markets, and so did they this time around post pandemic when the Fed was raising interest rates. They pulled out money, and that's when you see 22, 23, 24. We saw good outflow happening, in Indian markets from the FI. But now we all know that Fed rates have peaked out. Now, when to come down, whether it will come down next, quarter or next year when the new governor comes, we don't know. I'm hoping that will happen next year. But we are already beginning to see FI flows turning positive, in last couple of months. Even if they were not to turn positive, I don't think it's anything to worry given our domestic flows. But think about it. If they were to turn positive, what will happen to the markets? People who keep calling markets expensive, they will keep getting disappointed. I think small amount of FI liquidity, which is not even meaningful right now, has changed the market sentiment. In my opinion, when that acceleration happens, it will be another game to watch out. Valuation, again, very big subject. Most people, and I'm sure, most of you have read our letters recently, which is released. We write monthly letters, and I'm sure most of you wait for that and read that. And around valuations, we wrote because all the time we keep hearing India is expensive, sell it. I mean, that's a narrative which is there around, and we just don't agree with that narrative. And hence, we thought it's better to tell our partners, investors, clients that get the right perspective. We can build our perspective. At the end of it, you agree, not agree, it's your point. But at least we can build our perspective and share with you what we think about valuations, right? So Nifty is trading at 21 times. It is not not cheap, but it's not expensive. And I'll talk about it in a minute that why I don't think it's sort of expensive. See, valuation is a bit of an art and a science, right? Now, what is it that there are? Of course, there's a quantitative aspect in the valuation, right? But what makes it art is what I will explain you. So if you see, valuation is nothing. How do you arrive at a valuation of any asset class for that matter, whether it is equities, real estate, or fixed income, right? You arrive valuation of any asset class based on the future cash flow expected from that asset and discounting that at your cost of capital, right? It is as simple as that, right? So let's say you are in a bond. The cash flow is bonds cash flow is fairly predicted. When which date what will come. You will say I want to earn 8% rate of interest, and hence you will discount that cash flow at 8%. You will arrive at this asset price. Same way, if you want to discount that at 7%, you will discount at 7%, and you will arrive at the asset price. If you want to discount instead of 8% at 7%, your price of the bond will be higher. right? That's an if the discounting rate going down inflates the price of the asset. As simple as that. Same thing is also very simple if you have, let's say, rented property. And you know the rented property cash flow coming, you discount with a particular rate, you know the asset price, right? Most of you would be owning rented property and you will know that, right? But in case of equities, it is not so simple. Why? Because in case of equities, your future, you are not, you are not, most people say historical P of 18 times, hence it is expensive. But actually, it is discounting of the future cash flow. What is the expected value of the growth? What is the expected value of the, capital efficiency? So basically, broadly, what makes it the art is, there are four factors in, when I'm predicting the future cash flow, I need growth. What is the growth of the company? Now, to have the growth, I need to make a lot of assumptions, right? What will be the revenue growth? What will be the EBITDA margin expansion? Whether it will happen or not? What will the so I need to make a lot of those assumptions. My assumption and somebody else's assumption can vary, right? My depth of knowledge, my knowledge of that and somebody else's can vary, right? Same way, what will be that resultant capital efficiency of that business? What kind of ROC that business will make? View on that. Current ROC has no meaning. Like let's say, for example, a newspaper print company, you will see many of them, they are listed, they make huge profit, cash flow, high ROE, but still they trade single digit P. Why? Because the expected growth is hardly anything. Despite having high ROE, because there's no expected growth, you know, you tend to value that low, right? Same way, there could be two companies where my expectation of the growth is higher versus somebody else. Hence, I will value it higher, somebody else will value higher, right? So that's very, very important that you understand what is the expected value of these variables. Same way, another impact, very, very big part is longevity. Because as you know, in equity valuation, terminal value play a very big role. That what is the terminal value like? Of course, you can position the growth at 5 years. You can input your in your model 5 year growth, 7 year growth. But at one point in time, you will have to assume what will be the perpetual growth of the company, right? And hence, longevity of the growth, predictability of the growth is very, very important. And even more important aspect, which is today a lot more relevant, especially in the tech-oriented businesses, is non-linearity. That what is the linearity and non-linearity of the business? Like some businesses tend to grow small growth and suddenly the J curve of the growth happens, right? Because they are not capital intensive, especially it happens in a tech business. Like we had a company where we invested, which is kind of product company, IT company. It was used to grow at 8-10%. And when we sense, I'm talking about Newgen, which I'm sure many of you are in our shift portfolio, suddenly the growth profile of the company, everything else remaining change went to 25%. And with that growth, your ROE, ROC, every profile changed, and that company became, we made almost 5-6x return in that company, right? Because of J curve of the growth. And to arrive at J curve of the growth, you don't need too much, you don't need much investment further because already platform is ready. So that's the reason if you see platform companies tend to get far more valued based on the non-linearity of the growth than the company which will grow at linear. Some companies have linear growth because of the capex cycle, because they need capex. Some companies have linear growth because of market limitations. So again, multiple factors, but companies with a high linear, longer the longevity of the growth, high non-linearity of the growth, you will see high valuation. So all these factors make equity valuation very, very interesting, very, very, takes towards bit of art because, each people can have different depth of knowledge, different understanding of the sector, different sort of this thing. So that's the reason I think valuation differ from trade to people, and we think that India is in that space where over next 10-15 years we will see a significant growth profile. There's no country which offers India kind of profile. Look whether you look at growth, we are at a GDP level 6.5-7% growth, corporate earnings level 14-15% growth. Our ROE is at around 15%, again unparalleled in the world. Nowhere, you will have except US, which is valuation is again far higher. But I'm saying ROE is far far solid. Our debt to GDP is very less. So in that sense, we are a very solid macro country. There's much consistency of the growth can be there because of the strong macro health of our economy. Longevity reflects from the demographic setup we have. We are the youngest country in the world with 28 years of median age. China is 38 years. Japan, I don't know how old. Europe, I don't know how old. I'm sure you can keep guesses, but those countries cannot talk about. India is the only, country which has, we will supply 25% of world's incremental labor force. Two-thirds of our population is working age population. So when you have this asset, your longevity of growth is far more assured, both from a consumption perspective as well as production perspective. And that is what I think makes India a very unique opportunity. So, and of course, India is also, in some sense, I will believe that sensing non-linearity in many sectors, especially in manufacturing and technology space. As much as people feel negative about it, I feel that India, there's a very deep work happening, especially in the new tech space, where a lot of non-linear businesses are getting built. In 5, 10 years, we will see them happening, being felt in the market. But that's probably for some other day. But all I'm just saying, if you look at some of these factors, India is not offers a superior on all these four factors of the inputs in the future growth. And in fact, I would say, if India were, despite all these things, if India were to be cheap, I would ask why. Because if everything is well, why India would be cheap? It should not be cheap, right? In fact, I would worry in that. Then I will say that is some input in our, that my assumptions are wrong. If India, despite all the great factors, India is cheap, then I think I would ask whether something is wrong with India or not, right? In some of the factors which I talked about. So all I would say that, India is very solid growth over the next 10, 15 years. And coming to the valuation, like another factor, once you have the future cash flow, you need to discount it. In discounting rate, there are two inputs: risk-free rate and risk premium. Now, your risk-free rate, like I was saying, that 10-year difference between 10-year US and 10-year India is only 180 basis point and further going down. That tells you that, now if earlier it used to be as high as 5%, 5.5%, right? So if that's the case, my discounting rate is going down, and risk premiums are going down as we speak about, as our economy becomes more and more solid and more sustainable, right? So 2% drop in the discounting rate, everything else remaining same, changes the equity valuation by 35%. So if earlier, 20p was fine, 27p also should be fine, because, just discounted rate changing. So all I'm saying is that your discounting rates are changing, your growth is solid. Hence, India is not likely to get cheaper. And India historically, by the way, has remained expensive as compared to any other emerging market. I mean, I know there are lots of fans of China. China in last 20 years, despite having good GDP growth, has not delivered returns. I mean, it has delivered 4, 5% returns, whereas India has delivered almost 12, 13% CAGR in last 20 years or 22, 23 years. In 2002, we took. I mean, and risks will come. I'm not saying this. If you were to look at since 2002, we have all kind of risks. We had multiple changes of government, UPA 1, UPA 2. We had global financial crisis. We had 3G crisis. We had 3G scam. We had Fragile 5. We had, demonetization. We had GST implementation. We had ILFS crisis. We had pandemic. We had Ukraine war. We now Israel war. Operation Sindoor. You can take any possible crisis, man-made or human, natural, whatever, सब कुछ हो गया है. So, but India has compounded despite that. India has compounded despite all, I mean, better than any other market. And we have actually far better setup now as compared to we have ever had in the past. So why would India not compound better than in the past is something, I don't have any doubt about, but those who have doubt, good luck to them, is all I would say. Yeah, so I mean, just I will summarize. With the improving earning visibility, supporting policy environment, macro stability, we expect earning upgrade cycle. I think we will make new high in this fiscal year, and we'll continue to keep making new high every, sort of year, because I think India, for the reasons I just said, but we think that, 14, 15% compounding over next 10 years is possible in India. In ongoing wars, a lot of time we get a question, what do you think of it? So I always say that, wars are bad, wars are sad, a lot of humans die, we don't like it. But historically, wars were very relevant, because every time there was a war, oil price went through the roof. Because we had a cartel, oil cartel, which would kind of make sure that oil price goes through roof, and that would have impact on our economy. We have learned from, Ukraine war experience, where India kind of maneuvered by importing oil from Russia. Well, entire Europe and rest of the world reeled under inflation. India did not. And this time around, even if while war is happening, oil is in and around 70, 75, which is fairly tolerable range. So wars otherwise don't make a difference, but for the energy price historically, and which is I think has gone down. So hence we don't think there will be major economic disruption of these wars. Of course, it will create sentimental impact. We will keep getting worried. And as we see that worry also been going down. I mean, every day we read something happening in Iran, but markets are fine with it. The reason because there's no economic impact of on the world economic growth on that, and hence it is not a big worry. But of course, you never know. You keep on watching it out. We will remain in a heightened, you know, geopolitical conflicted environment over the next 5, 10 years, because the real fight is between US and China, and for supremacy. Who succeeds, I don't know, but at least it will keep creating sort of disturbances, and we'll have to live with it. Tariffs, again, we all knew that. I remember when we did our call on 15th April post, announcement of Trump, and I remember saying that, what our governor is doing is far more powerful than Trump is doing. And I think that has turned out to be true, because I think Trump was only creating, he was calling, he was bluffing, and I think China called his bluff beautifully and brought him to table. India, of course, played it very smartly, quietly. We are in, DTA we are doing with them. Of course, nobody's liking, India's rise, and we have seen Trump making bit of negative statements around, India, saying India can take care of itself. I don't want Apple to make manufacturing there. Again, according to me, they're all hyperbole. US knows that they cannot, they are two large democracies. Dependency on is a very high. India is a large market. Apple, no matter what Trump says, Apple cannot afford to mess up with India. So I'm saying, India understand its own strength. So sometimes, you will continuously have this not so good and good relationship, but I'm saying these are all geopolitical. They don't have much impact on the economy. I don't see, I believe that BTA will be fine. It will happen in, some due course. Without that also, it's, life is going on. So this should settle down soon. We are quite positive, but yes, short-term volatility can come from any reason, anytime. I have always long believed that risk always comes from unknown, and when the time when you don't expect. So only way to prepare for risk is your quality of your portfolio, quality of your company, and of course, quality of your manager. So, you have your money in safe hands. Don't worry. We are worrying all the time about your portfolio. So, don't worry. We will not do anything which is, not quality. Of course, outcome is not in our hand. We can only focus on inputs. And that is where most of our time and energy goes. Uh, there will be all kind of periods in long-term wealth creation cycles. We all know that. All of you have been accomplished investor for a long time. You've been with us for 6 years, and you've seen we've compounded through thick and thin. Uh, Long term, of course, success depends on how we behave in difficult times. Just to give you an idea, even in last couple of months of difficult time, we never questioned, of course, we revisited every stock, every company, but we never questioned, anything else. We just revisiting that anything changing on a factual basis for the company from a business model perspective, and we didn't have to make a lot of changes in our portfolio. So investing is a lot more behavioral than quantitative. I think you need to keep your nerves calm in difficult times. As I said, India is the best sort of investing opportunity in the world over next 10, 15 years. Keep your faith in equities. If you have surplus cash, deploy more. If not, stay invested. Markets always test investors' resilience and patience both. As the legendary Rakesh Jhunjhunwala said, to enjoy a 10 bagger, we need to have a stomach to hold the stock when it halves, patience while it doubles, conviction while it doubles again, energy while it doubles again, and courage while it doubles again. So identifying multi-bagger is easy. The real challenging is holding them through volatility. In Carnelian, in last 5 years or 6 years, we had many multi-baggers from 5x to 10x. And it is this ability to hold through this drawdown period, despite challenging time, has actually defined our performance in some of the slides which you saw previous. So, like I repeat, I end with that we are committed to create long-term wealth creation, for you, and happy to take questions from here.
Thank you, Vikas, for such a clear and crisp update on the market and the portfolio updates. What we'll do next is we'll open the floor for Q&A. Request all the participants for raise the hand in order to ask any questions regarding our portfolio and anything on the market. Please, investor, refrain from asking any stock related views which are not part of Carnelian Holdings. Udaya, you can ask the question.
Hey, very good evening. Am I audible, Vikas?
Yes.
Vikas, thanks for taking my question. It is always a pleasure listening to you. So you have mentioned about shift strategy. I think they have exited Syngene and the CN both. So CN morning when I was checking client portfolios, I still saw some CN exposure because that was some 3-4% of the portfolio. Is it exited from all the portfolios, Vikas? Is it a lag in reflecting in client portfolios, etc.? Sorry, if it is operational, maybe somebody else can later reach out if I.
It is the Cyient DLM we exited, not the Cyient. So, there are two companies. One is Cyient DLM, other is Cyient IT company. Cyient DLM is the EMS part, which we exited. Cyient we still hold.
Oh, sure. Oh, these are two different holdings, is it? Okay. Got it. Got it. Thank you. Thank you so much.
Amol, you can ask the question.
Yeah. Hi, Vikas. Quick question about any losses that you have booked in the portfolio in the correction that we saw. In the sense that why I'm asking is if any stock thesis got changed during the correction from September to this January, February, whatever we saw. Is there any booking of losses in that correction due to you changing thesis or whatever? Was there any of that sort?
Like I said, I think in my presentation also that we didn't have to make any change in our portfolio because our hypothesis changed around that stock because of the whatever news flow development happened, especially on the tariffs and all other fronts and all those things. Of course, we made certain changes where because of market, like we were looking to buy some stocks which are not available, but market kind of gave us very good opportunities. Some switches we made, but those switches were to kind of align towards a better opportunity than anything else. So we made, like I said, we sold Deepak Nitrite. Now we love Deepak Nitrite, great management, good business, but we felt that's a small position is better deploying somewhere else. So, so those kind of changes we anyway make in all the time. It's not necessary that because of this. So we didn't have to, fortunately book any losses as you were calling in this period because of that.
Okay, understood. Thank you.
Yes, Animesh.
Uh, Thanks, Vikas, for giving me the opportunity. I would like to ask, can you please guide me what will be the mid cap, small cap, and the large cap allocation in shift strategy? Because I had taken it as a risk on bet and invested in a small to mid cap category. But what I'm seeing is that there are a lot of large caps as well. Now I understand the markets were overheated. That is the reason you might have invested in them. If you could just tell what the ratio will be going forward.
And Tanay, please, look at from the fact sheet and just say the number. But shift continues to still remain mid and small cap. I would say, I mean, 80-85% would be still small and mid cap. We will have probably 2-3 names as the large caps in that. That nature of the strategy itself is a mid and small cap. And I mean, while we have not defined that way, but I don't get a lot of good high growth idea in manufacturing and technology where we are convinced in large caps. So, other than I think L&T and some IT companies
Yeah.
like so Tech Mahindra. Most of them are small and mid cap. Tanay, do you have the number with you?
So 10% is what the large cap allocation is, and the balance is on
Okay.
the small.
Okay. Okay. Understood. Okay. Thank
Yeah, I'll take.
Good, you can ask next question.
Yeah, good evening. Sir, regarding AFCON, still we are invested, and I haven't got any commentary on that.
No, we sold that because I think not because we were negative on the company. We had got some small allocation in anchor allocation in the IPO, and that was like some small 5-10 crore position. Now that was
you.
neither here or not there, right? So when we were consolidating this, I mean, we do once in a while, this anchor participation where you get to make some money. But if it is not, we are not able to build sizable position, then we get out. So that's how we got out.
Okay, sir. And one more question. What about effect of these magnets and all that on auto ancillary?
I think, this is again a lot of talk. Some companies have told us when we met recently, Hyundai, which is our portfolio company, that they are, getting manufactured in China and getting here, so their supply will not get impacted. So every company, see, look, time and again, these kind of challenges will come about. We had 2 years ago semiconductor issue, right? So I think good companies will manage those kind of things, and we do believe that companies will manage those things in their own way. I don't think it's going to be a sustainable big issue.
Okay, sir. Thank you.
Pranav, you can ask the next question.
Yeah, thank you, Mr. Vikas. Actually, I have a question with respect to banking and financial. Since you are uh, particularly overweight in this sector, what view do you have with respect to the credit cycle in the country? How are things going to shape up in the times ahead?
So I think we are very positive. Like I said, that we are very positive on the banking. As the interest rates come down, credit is expected to pick up. I think, especially the retail credit is doing very well. That corporate credit, I think, again, I would say that within corporate credit also, the working capital MSME is growing very well. The historical term loan credit is growing slowly, not because anything wrong, but also part of the market is shifted to bond market. So banks invest into bond and bond markets kind of. So that's again a corporate bond market. So that's also credit only. So net, I'm saying that banks, we are quite positive. We think that 14-15% growth is quite possible. Asset quality is in control. Growth will pick up. And again, we have invested into banks where we are comfortable about the growth. Yeah. Gayatri Kumar.
Yeah, yeah, hi. You're able to hear me?
Yeah.
Okay, so see this Bharat Amritkaal and your structural shift. Okay, both of them you are managing it, but performance of structural shift is way ahead compared to Bharat Amritkaal. Is it a question of timing or is it something else?
See, again, we can't compare two things. It's apple and orange. Shift is only manufacturing and technology focused, largely mid and small cap. Bharat Amritkal is a multi-cap, flexi-cap portfolio across all sectors. So there could be a period where one strategy performs because it's a very well diversified. Shift was a when we launched Shift also we were very clear that we will do only this and it's a niche focused product. And hence there was a time when so you can see this kind of difference in the different because the underlying strategy is different. Investing philosophy is not different, but underlying strategy, sectoral exposure is very different.
Okay. But this Bharat Amritkal also holds good promise, right? Because I mean, as its name suggests, we are looking at 4 trillion to 8 trillion. So I think lofty ideals are built into it.
Absolutely. So again, all I'm just saying is that Bharat Amritkal is more flexi cap portfolio. Uh, so they will it's going to be and Shift is more mid and small cap. So now you understand what the difference between flexi cap and mid and small cap performance. There could be times when Bharat Amritkal can be ahead of Shift, and there can be time other way around. But even Bharat Amritkal Fund has manufacturing and IT. Like I said, out of five, manufacturing, IT, financial services, consumption, and technology and services. Across all, uh, two segments of Shift is also part of Bharat Amritkal. So, like some investors who used to allocate partly in compounder, partly in Shift, have now combined in Amritkal because it offers everything else, double the amount and combined there. So, Bharat Amritkal Fund is a very good fund to get exposure to overall India story across market cap.
Hmm. Okay. All right. Thanks.
Let me take some questions from the chat.
Hi, sir.
Sorry, go ahead. Anna, you're saying something?
Sir, actually, I
Yeah,
wanted
you
to
can
ask
ask.
if the client had left it on you for a 5 years view, which strategy would you suggest to a client?
Again, your strategy should be outcome of what your client's positioning is. If let's say, you are looking at overall general exposure, I think I would say Bharat Amritkal Fund, multi-cap, flexi-cap fund is very fine. If let's say you are looking specific niche, mid cap, small cap in manufacturing technology, then shift is there. While shift, Amritkal captures that also, but it really depends on how your client's exposure is positioned. If let's say he is not much exposure to equities, Amritkal is the place to, in my opinion, or compounder or Amritkal is the place to be invested. But if let's say he's invested into a lot of multi and large caps and other funds, and then you can take a sort of risk in or exposure in the shift strategy. So it really depends on, as far as we are concerned, our investment philosophy does not change anything. We apply the same amount of rigor, approach to what we do across our products.
Okay. And so lastly, from return point of view, what is better, AIF or PMS, since both our strategies are running on the same philosophy?
So again, there's no difference between AIF and PMS. It is the strategy which delivers return, not the AIF and PMS. The only difference in AIF and PMS, in AIF, it allows us a little bit more flexibility to do anchor and participate in QIP, which we cannot do in the PMS. So to that extent, it gives a little bit added advantage, but that could be depending on what market cycle you are. It could be advantage or disadvantage. I always preferred, if somebody asks me my personal view in AIF, it makes no difference. It is the underlying strategy which delivers the return, not the vehicle.
Thank you. That's it.
Let me take some questions from the chat right now. I think there's so many questions. How much positive and negative surprises was seen in actual portfolio level earning of? I think I have covered this. Uh, Please take us through your products, which is the most beneficial over 10 years. I think I have kind of answered this question already. I would say if your 10-year view, use Bharat Amritkal or multi-cap product because we will capture everything in that. I mean, a lot of times, let's say if I have 100 rupees, people allocate 100 to large cap and 100 to mid and small cap. Actually, Amritkal offers both of that. So you can double your money and put in Bharat Amritkal because it offers both. So rather than splitting into multiple products, this product gives you combination of that. Rationale of Edelweiss, I think I kind of explained that. Our view on Indostar Capital, it's a stock which we bought at point 0.3 book. Like I said, we will not buy NBFC, which are small, but this was such a small screaming risk reward. When we bought it was 100 rupees, right? And nobody wanted to buy. Institutional holding was zero, but we did a lot of work on that and we got so convinced that we picked up the entire block which was available. And the stock is up almost three times in last 1.5 years for us. I think still Brookfield owns it. Company is reviving. Company is doing well. They just sold their housing finance business. So we think as long as we see, and the new CEO is very good. So we think that it is going to continue to do well. So till the time it's doing well, we'll continue to hold. Anyway, we have a huge margin of safety in our, the already kind of a 3x. But that does not mean that we'll continue to hold forever. We are watching. Company has still potential, and we'll keep reviewing. Our view on PSU banks is very positive. I think most banks are doing good job. The ROE is going up. The valuations are very cheap, so we are positive right now. We own some of them. Real estate sector also looks very good. The only thing you have to be worried about is that real estate stocks have gone up significantly, and now they are committing to a lot of new projects at a higher cost of capital, at a higher cost of land, and the real impact of that will know only 3-4 years down the line. So stocks can do well over next 1-2 years, but I don't know how they will do over next 5 years. So one has to be playing more tactically here than really, and one has to, again, it's the company to company, so you really can't watch out with that. One thing I'm seeing, a lot of real estate companies are now committing a lot of new projects at a higher land value, and that kind of can be a risky strategy. I think valuations, somebody's asking, Tushar is asking question, but I think I've kind of covered in valuations, so I'm just kind of reading through the. I think Abhijit has asked a question. If you have discovered multi-bagger every year, why your shift strategy underperforming last 1 year? First of all, I think it's not underperforming last 1 year, but doesn't matter. No good stock picker can perform year after year, every 6 months, 3 months, 12 months performance. What we do is we kind of can pick up stock and hold on for very long. Many times the stock which you are holding itself might not have performed in last 1 year. It could be very well with it. Still, we will not sell if we are convinced about the growth. So I don't think we are promising our investors that we will outperform on all periods, all times. What we are saying is that we are looking to create, risk adjusted, alpha over 5 to 10 years, and I think we have been reasonably successful on that. Also, very often we don't see the beta part of the portfolio in a mid and small cap strategy positioned vis-a-vis BSE 500, which is a large cap index. Unfortunately, SEBI does not allow us to compare with multiple indices. Our beta is zero point 0.9. If I were to do with the mid and small cap index, our beta would be probably 0.7. So we have, as a portfolio manager, I have two jobs. One is to enhance return, and secondly to reduce risk. At times, I might not be able to enhance the return, but if I reduce risk, it's fine. So I think probably the second point gets less attention, less importance. But I would always say that pay attention to both as an investor. That's a very, very important point. How long you wait before you decide to exit a position? I think we basically sell in the four circumstances. Number one, when we realize that our original hypothesis for what we invested was itself wrong, galti ho gaya humse, then we will sell irrespective of what the price is. We will book loss also. Secondly, when we realize that whatever hypothesis we made, something materially has changed on that hypothesis, and things change, right? You don't say this will happen, hence it will happen. So when we realize that it's changed, you sell. Third, when we think what hypothesis we made has played out really well over next, whatever, last 2, 3, 4 years, and now risk reward of remaining invested is no more there, then you sell. Like, for example, I said, we sold Timken 2 years ago and we bought it back. For 2 years, we invested into something else. So that time, risk reward of remaining invested in Timken was not there, and stock is down and time has passed. So hence, now we're better off selling and buying later. But then you have to understanding of the business and cycle and valuation, everything else. And the fourth, when we find a new idea which is far better than existing stock, then we sell. So these are the four conditions under which we sell. And we really don't wait. So जब हमको समझ में आया तब कर देते हैं. So it's not that we don't do hope trades. Of course, when something is not playing out as per hypothesis, then we see that should we really give some time of a quarter, 2 quarter. That depends on company to company. There's no standard formula for that. If your fund has launched these schemes before COVID 2021 would be out. So I think probably you don't have history with us. We launched our fund in May 2019, which was, I think, before COVID, and that fund delivered 8% outperformance over last 6 years. That was our first fund. And very often when we launch shift strategy, this was not because of the COVID lows. We launched in October 2020. So from that point in time, also our outperformance is 16-17% per annum. I don't think there will be any fund in the street which has for 5 years period 16-17% outperformance consistently and sustainably. So, it's not really, if you ask me, it's not really credit to COVID. It's credit to, I think, probably picking up the theme early. Irving, could you explain why capital compounder is better than AIF? Then, basically, why AIF is better than PMS? Very good question. So I think you must know. I mean, again, there's a little bit of history to that. The capital compounder AIF is what we started with. PMS is a strategy we acquired later, from another firm, and because of that acquisition, it came with a legacy performance. So to that extent, you will see underperformance in the portfolio. And after that, I think portfolio is more or less same, except the fact that wherever we get QIP and all those things, which we can do only in AIF, not in PMS. Other than that, I think you will not find much difference into both strategy. So historical underperformance is something you can't do much about. But if you look at, let's say, last 1 month, the fund is up. Both funds are up between around 7.5%. Last 3 months, both funds are around up 21-22%. So we have also kind of aligned portfolios over the years with that post acquisition of that strategy. Would you recommend lump sum investment or Yes, I mean, look, again, in my opinion, SIP is good, but SIP is only what I call man ka shanti, because if you start an SIP, how do you know that next month market will go up and down? Nobody knows, right? Over next 3 months, it is just a fluke, in my opinion. So I would say that depends on your comfortable, but a longer the horizon of the capital, you are better off, in my opinion, doing lump sum. But let's say if you are no comfortable because you are here all the time, you can do SIP also. Makes no difference to us. I would always say that, take a call. If it is long-term capital, whether you invest, in my opinion, 10 years down the Nifty will be 1 lakh to 1 lakh 25,000. So whether you invest at 24, 25, 23, it will not have much impact. The fact that you will invest will have an impact. So I think, Vijit, you got our portfolio last, 3 months is not down. I think I don't know where our client portfolio shift is down 9.2% versus. I think it's you can check with Tane, post. I don't think it can be true. Something is wrong. So please, connect with the Tane and Tech Mahindra. I think I mentioned that we are positive, so I'm not repeating. What is AI versus PMS? I think please connect with Tane. I can explain you later. We don't invest into gold and silver ETFs. We think equity is something what we understand the best, and we think that equity delivers better return than any other asset class over a cycle. So hence we kind of believe and continue to remain invested. Why would rate cut helps bank when they have to lower the rates? Good question, but Venkat, I think the growth accelerates with the rate cut cycle, and I think as the rate cut happens, obviously the deposit rate also goes down. So you might have a little bit of impact on the NIMs for a quarter or two, but eventually they pass it on back, right? I mean, deposit rates goes down. So that's the reason I think, so more important is the acceleration in the growth, which happens, and that's the reason I think, and acceleration in the growth as well as the discounting rate, which I talked about. Because when the discounting rate goes, this of course applies to everything, not only banks, but in general, banks has both kicker. Our view on housing finance companies, we like housing finance companies, but I think, we like PNB housing, but again, you need to find the right valuation, right company. So right now we are playing through Aditya Birla Capital, which is also a very high growth housing finance company. So that is what we are playing. I think somebody shift and compounder as a 39% overlapping as common stock. So it is fair percentage. How much percentage of overlapping you think fine for any strategy? So please understand compounder is across all sectors and shift is technology and manufacturing, right? So if I like something in manufacturing which is good, I am better off having that also in compounder as well, right? So to the extent of sectoral overlap, you will find sometimes we have of course different stocks as well, but there's a sectoral overlap, which we've been saying, you will find many common stocks across our portfolio because I can't say if I like a particular company in the manufacturing, which is a good growth. Let's say, for example, Lotus Laboratories, you will find in all our portfolio because that has been a very high conviction call for us and it has paid off. But if I just to avoid overlapping, if I don't buy, I will be doing this service to one portfolio investor versus other. So as long as it has kind of same conviction, I mean, to the extent of within the framework of the portfolio mandate we have defined, you might see overlap happening.
So due to time constraint, we can take a couple of last questions now.
So I think I'm kind of roughly more or less through. Uh, if there are any more, I mean, Dimple, I can take from, I think on Dimple or Finwise, who anybody can ask questions. Yeah. Dimple, you
Hello.
want to go ahead? Yeah,
Hi,
Dimple.
Vikas. No, I'm Finwise, Sucheta from Finwise. Hi.
Yes, yes.
Thank you so much for your presentation and so much meaningful data points. So we understand that, inflation, cost of capital, liquidity, capex, or consumption, either they are doing reasonably well or will play out in coming 1 or 2 quarters. What is the one thing, because you will be worried then? I mean, as an investor or distributor, can't just accept everything is going fine.
Right. No, see, look, as an investor, you have to always be worried, right? You have to keep watching out for potential risk because risk, like I said, risk always comes from the sources you don't expect. and it comes when you don't expect. So risk is always unexpected, unexpected. I can give you a very intelligent sounding answer, but fact is that that is only intelligent sounding answer. That's not a real answer, or that's not a really good answer. If I were to say, I can give, oh, now it's geopolitical situation, tomorrow something happens, it might happen, but who knows what will happen, right? I think in a historical context, we would have said if Iran-Israel war escalated, market would have tanked, but have they? So what I'm saying, risk always comes from, risk which you don't expect. So currently, like I said, I don't see a major structural risk. Tactical risk can come from, anywhere. Tactical risk can come from anything, any new developing happening, which you and I can't predict. Uh, you know, uh, on the horizon, I don't see any major structural risk, to be very honest. Right now, I see a good tailwind which is happening in India. In fact, unfortunately, there's a lot of skepticism in the market, especially all around valuation, and that's the reason we actually thought it will be good to kind of share our thoughts on valuation through our note and through this call. Yeah.
No problem. I have one more small question. And what would be the average market cap of your small cap universe?
I think, Tanay, do you have that number of each strategy?
It's 42,000 crores weighted average market cap for shift strategy, and 2 lakh crores for compounder, and for Amritka is 1.5 lakh, 1.5.
No, actually, my question was you will be having a universe for small cap, mid cap, large cap separately, right? I
Yes.
mean, yeah. So I wanted to know, not the not the strategy wise. What would be the average market cap for your universe of small cap, maybe?
So if you see when Tanay is giving you a shift strategy at 45,000 crore, it is a weighted average market cap of our portfolio based on the weights which we have. So shift
So
is
that's a
broadly,
mid and small cap, right?
yeah, that's a primarily mid and small cap, right? So 90% is mid and small cap there. So
Okay, I can take a fair approximation from there.
otherwise, you can take Tanay can give exact
Yeah.
data,
No
once you reach
problem,
out to.
no problem. I'll get back. Thank you so much.
We'll take the last question. Dimple, you can go ahead, please.
Uh, what are the sectors that you are looking at for next 5 to 10 years?
I think, this is again, and then I would request, I don't know if you already put on the chat Bharat Amritkaal ka video, that would be great for you to listen. I think it covers everything else, but I will say broadly, we have defined into 5 broad buckets. Financial services, which will do very well. Uh, Manufacturing, which again, we've been very, very big proponent, and I think that will do very well. Consumption, when as per capita income goes from $2,500 to $18,000, again, it's positioned to capture a lot of it, and we will benefit in that. Infrastructure, India is building port, roads, railway, ports, everything else, right? And that I think is very, very potential opportunity. And lastly, services sector, which includes IT services and non-IT services like travel, tourism, and all those things. So across these 5 buckets, you have to identify companies and ideas, and they are very, very promising. So we are right now very bullish on banking. Within all these things, our current overweight is BFSI, pharma, APIs, manufacturing, auto components. Some of these are our current overweight situations. But like I said, they keep changing depending on our assessment of the situation. But structurally speaking, like I said, India continues to remain one of the best market, and we'll keep saying till the time we believe that it is there. And thank you very much for your time today. And I always look forward for this engaging sessions. I hope this added value answers some of your questions. If some of them are still unanswered, you have still open questions, please feel free to reach out to us. Then has put his email address. You have our numbers. We will always be open to share any of the insights. And Tanay has put this presentation on the chat. Please copy and listen to this. This is there on YouTube. It's a very, very it's a very good data sets you will know on India story. Thank you very much.